Harris is an international law firm. We do a ton of foreign direct investment, particularly in the real estate space. We have offices in the U.S., here in Portland, Oregon, where I'm speaking. And then on your screen, you also have Simone Malinowski. He's in New York City, New York State. And you have Steve Changlin, who is in our Seattle office. He also works out of Bellevue, which is a nearby office, a suburb of Seattle, effectively. We also have offices in places like Los Angeles, Phoenix, and we have international offices in Beijing and Barcelona. So we've been handling this work, I guess, on behalf of inbound buyers as well as domestic buyers for many years. Steve, Simone, and I have probably 40 years of collective experience, and then the greater group, the foreign direct investment group and the real estate groups, has a lot more than that at the firm. But that's about it. That's sort of the high level intro. I'm sorry for hopping out of order a little bit. On the commercial real estate side, we're also seeing a big spike in activity, particularly over the last few quarters. Sales are now at pre-pandemic levels, fueled by historically low interest rates, but also just, I think, a general belief by a lot of investors that the worst is behind us. Investors bought about almost $150 billion of U.S. commercial property in the second quarter. That's literally 3 times the amount that was bought over the same quarter the year before during the pandemic, right? So in that sense, it's looking like a really fast rebound, probably faster than after the global financial crisis of 2009. The market looks different than it did in March of 2020. Certain cities like New York and San Francisco are rebounding, but more slowly than really hot areas of the U.S. like the Sun Belt. Certain classes of properties are slower to come back, say downtown office buildings or convention hotels. Other classes of real estate, industrial, weren't even affected really by the pandemic and continue to sell very briskly. So that's kind of like big picture snapshot. The question really, after knowing all that, is why would you invest? Why invest in U.S. commercial real estate? I think the first reason is just an obvious one, is high income potential, right? With commercial and mixed use buildings in particular, you'll see higher rents and price tags, and thus the potential for higher returns. You'll also see tax benefits. The U.S. tax code is enormously favorable to real estate investors. And that became even more true after the Tax Cut and Jobs Act of a few years back. What's so advantageous about tax? There are a couple of big categories in my mind. First, you have something called depreciation, and that's the ability to book a loss in value of a property over the course of its useful life. So even if the property doesn't actually become less valuable, even if you wouldn't take a loss if you sold it, you're still allowed to book a loss in value every year over, in the case of multifamily residential, 27 and a half years, or over a 39-year schedule for commercial property. And when a property is sold, the seller would, in theory, owe tax on the difference between the depreciated value and the sale price. We call that depreciation recapture. That's the point at which deferred taxes are supposed to be paid. But another big tax advantage is you can carry that property or put it into a like-kind exchange. We call those a 1031. You've probably heard that term. That allows a property owner, including, say, an LLC owned by multiple investors, to sell a property and put that money into another property if done within, I think it's a 6-month period. So if that's done correctly, the owner pays no taxes on the gain of the sale of the original building. So you've got depreciation, you have the ability to do 1031s, you have something called qualified business income deductions, which was a big change from the recent Tax Cut and Jobs Act. That is basically an incentive for companies with a large number of employees. You would think it wouldn't apply to real estate investors, but during the tax bills negotiations in Congress, an exemption was added for real estate. So instead of considering employees for their deduction, real estate companies can use a different calculation based on their assets. So you've got QBI, and then there's all sorts of other small things like, it's not small, but new provisions for real estate investors like opportunity zones and other things that I won't get into in great detail. Safe to say that it's a really nice tax environment for an asset class to invest in. And then you have things for individual investors too, like estate planning benefits. The tax code is written just generally so that the accumulated capital gains taxes are supposed to be paid eventually, right? But if an individual owns a real estate, properties can be held until death. At that point, all the embedded capital gains are wiped out, so no capital gains tax is owed, and the family inherits the properties at whatever value they were appraised at on the date of death. So that's kind of big picture stuff. Those are generally applicable tax advantages to both residential and single family homes. Some of the deductions went away, for instance, mortgage interest deductions and real estate tax interest deductions went away with respect to single properties, but I'd say it's still a very good tax environment. Choices, U.S. real estate investment options run the gamut. You can invest in things like a Class A office building. You could keep it small, putting those dollars toward a single home or a storage facility or, I don't know, an industrial warehouse or a condo community. There's a lot of flexibility both in what you invest in and in where you can do it. Another reason people really like real estate investment is it's tangible, right? People understand it. A lot of people can understand real estate better than stocks because they grew up with it, or real estate investing is in their family or in their culture. I mentioned the superior tax benefits. I would say that real estate's interesting and attractive because it provides month-to-month cash flow if you rent it out. So, it's almost impossible to find a dividend-paying stock that kicks out standard payments comparable to what you get in a standard triple net or other type of lease. I would argue that debt, or what we call leverage a lot in real estate, is safer in the real estate investment class than with stocks. And the simple reason for that is real estate prices don't fluctuate as widely as stocks do. Certain types of debt-related investment with stocks are particularly risky. If you short a stock, for example, your losses are potentially infinite, and there's nothing really analogous in real estate. If you borrow to buy, the chance of a property even going to zero is remote to impossible, right? And the last, in my mind, big advantage of real estate is it's an effective inflation hedge, or it has been historically. People think of it like that, and it's true. As long as your taxes and maintenance don't grow by more than inflation, you're ahead. And the reason for that is rents are expected to go up at the cost of inflation over time while your mortgage is generally fixed, right? So if you lock in a mortgage for a certain period, and commercial are usually shorter than residential, maybe it's 10 in commercial or 30 in residential, it's going to stay at a fixed rate all the while the rents you collect will grow up. So those are kind of the why invest reasons for me. People will tell you other ones, but those are the big ones. I'm going to turn it next over to Steve to identify urban acquisition opportunities, or talk about identifying urban acquisition opportunities. And maybe Steve could self-introduce a little bit better than I introduced him.
Thank you, Vince. That was a very good summary of the advantages of investing in real estate. And I will be focusing on identifying urban acquisition opportunities. And I would like to add a little bit to Vince said. One thing that I would like to add is that there is a global trend into a concentration of population in urban centers. And I believe I've read somewhere in the last census that the United States, 80% of the US population are considered urban. So although during the short term, COVID is dispersing population to more rural areas, the general trend is towards urbanization. And with the general trend of urban concentration, investors should also understand the different urban acquisition opportunities in order to become a better investor. And how to identify urban acquisition opportunities. That's a very big picture type of question. And how I would approach it is that an investor should first focus locally, right? You want to understand the local market conditions, be familiar with the type of projects that you want to acquire. Is it a condo, a smaller project like a single family home, a condominium, or are you looking into multifamily, strip malls, retail, or are you a developer who wants to redevelop a site into, let's say a vacant land, you want to build a condominium high-rise. And so along the same lines, you want to think about the type of market you are, you want to think about the type of market that you want to be in, and also the type of project that you want to acquire. And also the general market conditions surrounding that investment. So for example, if you want to invest in a gas station, do you want to invest in a gas station when across the street there's a Costco gas station? Or do you want to invest, if you are an apartment developer, are you going to invest in a apartment building when in the next several years there are going to be other apartment complexes going online? So in essence, investing in real estate is like investing in a business. You want to do your homework before putting your money in, and you want to understand and do your research on what other people, your competitors, are doing, and also and do some due diligence prior. Another important aspect of identifying acquisition opportunities is also doing the financial calculations and other pre-acquisition due diligence. So some questions I would ask is, does the project pencil out? Meaning, does it make financial sense, right? Is your, if you are buying with debt, are your income streams going to be enough to cover the debt? And if you are going to be remodeling or improving a project, what are the estimated costs and the actual costs? And I find that a lot of my clients, they would go into a project with an idea, oh, this is the estimated costs. But when they are actually in the project, the actual costs, they find out is a lot higher than the estimated costs. Another thing that an investor would want to consider is, prior to entering into a contract to buy a property, there is usually a period of due diligence. And this due diligence period is fairly important for investors so that they can determine the viability of the project. For instance, if a developer wants to redevelop a commercial site, they probably will want to do a survey, find out what are the underlying, if there are easements or any other type of agreements, boundary line issues that would prevent the redevelopment plans. Or another thing is, a very important thing that the clients should consider, investors should consider, is the environmental issues. So I had a client several years back. They decided to buy a property they wanted to redevelop into an apartment building. The building used to house a dry cleaners. And so they didn't consider too much the environmental impacts of it. But once they bought it, several years passed, they thought they were in the process of development plans, getting their architects, and then suddenly they get a letter from the Department of Ecology saying that, hey, there are remediation issues that you have to remediate. And so with that letter and the subsequent issues that arose, their costs increased over $1 million. So those are just some of the I guess, minefields that a real estate investor would be facing, and a real estate investor will want to consider prior to jumping into the investment. And I think it's very important for the real estate investor to, and we will talk about this a little bit later, is to get a good group of people that you trust, advisors that know the area, know the market conditions, have gone through the process many times, and they will be able to provide good advice before you make the real estate investment.
Thanks, Steve. That's really helpful. One thing we meant to mention at the outset is, if people have questions, feel free to type them in, and we'll weave them into the presentation whenever we can best get to them. Next, I'm going to turn to Simone to talk a little bit about the urban development process. Simone, can you explain that to us?
Sure. I think what Steve was talking about is a really good transition. And I think it's important at the outset to kind of talk about why we break out the development process. And the way that we think of the development process as a part of separate and apart from just real estate investment, is it's kind of the value add component of real estate investment, right? So generally speaking, when a property is being developed, it either involves building from the ground up on a vacant piece of land, demolishing a building that exists already, and then building ground up from the now vacant piece of land, or renovating an existing building. And the reason why people are interested in pursuing those sorts of opportunities is because generally it provides the opportunity to increase the return that you're getting on your investment, be it in the possibility of having a building that you can sell as a whole, or condominium units that are now more valuable that you can sell, or a rental property where you can get more money per unit on a monthly basis. And the reason why it's a little bit of a different process in the urban context than anywhere else is because, generally speaking, and this is a kind of, again, generally, but not necessarily the same across various jurisdictions, is that developing property in urban areas is a little bit more complicated, a little bit more expensive. There are more regulatory issues to deal with. There are a lot more actors in the sphere because it's more competitive and there's more money at stake. And so, the balance in that is that generally speaking, when there's more people involved and it's more competitive, there is a higher rate of return, or at least the possibility for a higher rate of return. But that's kind of what makes the urban development process different than the development process in non-urban areas. And the reason why we harp on it is that it is, in urban areas, potentially an incredibly complex and highly regulated process that makes it really important to understand what you're getting into before you begin your investment. And so I thought what would be really helpful is to just kind of generally walk through what the process is from investment through the end of one development cycle, just to give everyone a sense of what the process looks like. And Steve correctly noted that due diligence is an incredibly big part of this. Step one in that is identifying an actual property to invest in or acquire. And that in and of itself is not necessarily the easiest thing to do in the world, because in most urban areas, there's basically a limitless number of investment opportunities and different properties to invest in. And step one is just identifying it. And at that point, you really start beginning to do your due diligence process, looking into what can be done with the property, what the finances look like, where there are opportunities for changing the property. And at that point, you're already beginning to pull in various different advisors, attorneys, architectural consultants, environmental consultants, which Steve pointed out, which can be a huge issue for ground up construction, as he pointed out, because simply missing that small issue could be $1 million swing in your development budget. You then have to deal with arranging for financing, assuming that you're not buying your property for all cash, which almost never happens from a development perspective. You have to then negotiate and enter into a contract with the seller. Again, ideally, you have various due diligence contingencies in the contract, but you already are in the process then where you're putting down a sizable amount of money for a down payment. You have to prepare construction plans, be it renovation or demolition, and then ground up construction. You have to contract with someone who actually does the work, which is the contractor, potentially, and we'll get into joint venture options, but potentially subcontractors, architects, engineers. Then you get to the closing, and now you finally actually own the property. And then you actually have to go through the entire construction process, which involves permits, getting plans approved, making sure that you have insurance, making sure that all of your contracts with your various parties protect you in the right ways. And inevitably, because it's construction and it's complicated, there'll be various disputes that arise over the speed of the project, the cost of the project, people getting hurt on the project. And, very quickly, as you start talking about this, you realize what a complicated process it is and why we talk about it in such a way that in the urban context, it kind of requires a different level of involvement and guidance and potentially partnership, because at any step of the process, things can and often do go wrong. And when you talk about, one of the things I mentioned is obtaining financing as part of the process. And in a vacuum, you can say to yourself, well, okay, so you've gotten a loan and you now have this loan and they helped you pay for either purchasing the property or actually building the property or both. But what a lot of people don't think about initially is that loans have what are kind of part of what are known as carrying costs, which means that even though you have a piece of property that you now own that is either, well, hopefully appreciating in value because you've made a wise investment, until that asset starts generating revenue, either as a rental building or as a building that you've sold, you still, unless you've worked out a special arrangement with the bank, in all likelihood, have to pay a monthly cost. You have to pay your contractors, you have to pay your vendors. And so any situation in which something goes wrong because you didn't understand what the process was or overlooked a potential issue means that you have potentially added months, if not years, to your development process, during which your bills continue to accrue without actually generating any return on your investment. And so it really does require fundamentally understanding and planning for these issues as you're going through kind of evaluating the investment and what your options are. And a few things that kind of jump out that are separate from the issues that I've mentioned already that are really, really specific to urban development. Permitting, and I mentioned permitting because every jurisdiction is different. Every jurisdiction is run by its own bureaucracy. They have their own rules about how they want buildings constructed, what the requirements are, how often things are checked, and understanding what that process is, how long that process takes, and the ramifications for getting steps in that process wrong are really important. Zoning is incredibly important because if you don't check zoning, if you decide that you're going to do something without fully understanding what the zoning implications are of your property, you can end up in a situation where you start your project and all of a sudden it turns out that what you were planning on doing with that property isn't legally permissible. And it happens on occasion everywhere. It happens surprisingly often in New York. And you then have real issues because you now need to pivot on your project after making a huge financial commitment and time commitment. New York has a few very interesting jurisdictional specific issues. There's something known as condo books, which are basically a strange intersection between securitization of real estate and real estate itself, which is you need approval in order to sell condominium units to the market in New York. And if that's a process that you don't understand or you aren't familiar with, when you decide that you're going to invest as a foreign investor in a condominium project in New York City, not starting that process early enough, not understanding the rules and regulations governing that process can be a month, if not year-long delay. Another really interesting one that we deal with on a really regular basis are license agreements, which is something that tricks up lots of foreign investors. It's something that I'm personally dealing right now with on 5 separate projects, which is in New York City specifically, and this applies in other areas, but sometimes you need access to your neighbor's property in order to build your project safely, be it from a foundation perspective or protecting the neighboring property. And oftentimes that requires getting the neighbor's consent. And again, these are the sorts of things where if you don't know that this is an issue, it can cause all sorts of delays. And this is kind of why I'm going to kind of pivot to the next topic that we wanted to talk about, which is exploring joint ventures. Partnership is something that we often see our clients do, not just from a foreign investment perspective, but also domestically. And I'll pause for a second and kind of explain what a joint venture is, because it's something that we attorneys throw around on a regular basis, but not everyone understands what it means. A joint venture, the way that we refer to it, is basically two parties or more than two parties coming together to get involved in a real estate investment together. And oftentimes they're referred to either as general partners or limited partners, general partners who are more responsible for the actual development process itself, construction, overseeing everything, versus limited partners who are generally what we refer to as silent investors, who are contributing the capital to develop the property. But it is a very common way of basically allocating expertise from the various parties who are coming to a project in the most efficient way. And there are various partners who have different levels of specialization. There's the people who are historically builders, and they oftentimes will come up with less capital as part of the investment, but they actually get into literally the ground to get the project done, versus the kind of finance investment side, who are more responsible for arranging the financing and making sure that all of the books are done properly and that the numbers all add up at the end of the project. And the reason why joint ventures are particularly useful and important for foreign investment is because, as is clear based on, I hope it was clear as I kind of just went through the issues that are endemic to the urban development process, if you are coming from a foreign jurisdiction and don't have experience in the jurisdiction where you're investing, be it New York, Seattle, Portland, LA, anywhere across the country, you don't know what you don't know. And you can get into all sorts of problems by making an investment because you've overlooked something that you didn't know was an issue. And that can create all kinds of expensive problems. A very kind of straightforward way of shortcutting that issue and not maybe losing a little bit on the percentage points on what you're making on the project, but increasing the likelihood of success is partnering with someone who is local, who has the market knowledge and the experience with dealing with the issues that are specific to the jurisdiction, and actually helping get from investment to an asset that's generating revenue for you. And it's why we see lots of people who come in, they facilitate a relationship, they enter into a partnership with someone on an initial project. And if that project goes well, they work on project after project together, because it ends up being a very strong business relationship where people have allocated their resources and their expertise in a really efficient manner, and it just works. Now, there are lots of different ways to go about entering into a joint venture. There are different corporate structures. We generally see them as operating agreements or partnership agreements. And what those documents are basically contracts between the two parties that really concretely set forth the terms of the relationship. Who is investing what their returns are on their investment, when payments need to be made to each party, who's responsible for what portion of the project, what authority or management is required for every given step of the project, what requires unanimous consent, what happens when things go wrong. All of these sorts of things are issues that we deal with on a daily basis in terms of structuring the partnership agreements in such a way that both sides are protected and that we kind of account for all of the variables or as many variables as we possibly can for dealing with difficult issues that people aren't expecting that arise kind of when it isn't really expected. And it's we really have found that joint ventures for a lot of clients is an efficient way of mitigating risk as best as possible when entering into a new market. One of the things I really was kind of curious to ask both of you about, obviously in New York, we have a lot of, I think, kind of strange real estate specific issues that come up, but I imagine that it is very similar in Portland or in Seattle.
Yeah, I think so. I can answer a little bit for Portland. I think, yeah, number one, with respect to local zoning code and approving properties and uses and stuff, like Simone said, every jurisdiction is a snowflake. Everyone is different. Everyone has different zoning codes. Everyone has different regulatory agencies. A lot of times you work with a lawyer or a developer or somebody who does this stuff a lot. They will know people inside the agencies. Here in Portland, it's BDS for the building code stuff, and then there's an environmental agency and everywhere else, and there's a lot of overlap there. I'd say also one thing that's particular to certain jurisdictions is general market terms, like what stuff sells for right now, right? Like if you were to come to me and say, I want to buy an industrial property in Portland and it's selling for X, I would run a few simple calculations and I'd say maybe that looks like it's about a 6 cap. A lot of stuff selling at about a 6 cap right now. That makes sense here right now. It's a tighter market right now, that kind of a thing. So I think like each jurisdiction is really different in a lot of different ways. I think they're even different sometimes with respect to financing, which you think should be more nationalized, but it's sometimes not. And especially, you'll find a local bank or a local credit union that is a lot more willing to be flexible with you or work with you especially if you have an ongoing relationship. And I've found that to be the case with certain clients of ours here in Oregon over the years, and they'll look at things differently too. Simone did a good job kind of talking about financing earlier. I want to talk just a little bit about it because I think it's so important. I think big picture, I think if you're investing in homes, right, and residential real estate, I think those underwriting terms and requirements have tightened up, right? And for good reason. Since the 2009 financial crisis, a lot of that was bad underwriting, bad loans. People couldn't pay them back. All these mortgages were underwater. It's a little bit different now than it used to be. Whereas commercial underwriting, in my experience, is a little bit looser. But when you talk about commercial underwriting, you're talking about a lot of things, right? A lender is going to look at a property that needs to be developed a lot different than it's going to look at a property which is already in use. And when they're looking at a property that's already in use, they're going to say, well, what kind of use is it? Is it owner occupied? Are you buying this property to move your business there? In which case we kind of need to look at your business financials and understand if it's underwritable in that sense, or are you buying it as a straight up investment property, which I think a lot of you guys on this webinar are thinking about doing. And in that case, a lot of underwriters will look at what is the cash flow of the property right now? How much are you going to buy it for? Often they'll write to the leases. They'll say, look, this lease looks good to us. It's got 7 years of term left on it. We're willing to give you a 7-year note. We're willing to give you a 10-year note, et cetera. So I guess I would say that, local issues can be anything from financing all the way down to permitting. And it really, really helps, like Steve said, to do your research, not just on the location, but on the whole local environment. That would be my sort of high level meandering answer to Simone's question. I don't know if Steve has input.
Yeah, I think on top of that, with respect to jurisdictional issues, so I mostly my office is in Bellevue, and across the freeway, across the water there in Seattle, the city council has recently proposed a lot of very tenant favorable statutes that prevent landlords from exercising their rights under the lease agreements. So in order for investor, the key thing, I think what Simone and Vince has been talking about is that key is having enough cash flow to generate value for the property and to cover your expenses, and you can get the appreciation when you exit the property. But during the project, if there are municipal codes or city codes that are being created or promulgated by I guess by the people in charge that are not favorable to the landlords, then that is something unexpected, and that's kind of what is going on in Seattle right now at this point. And of course, I understand that during the pandemic, there is a big push to protect tenant rights so that they can get over this period where a lot of people are away from are not able to work and earn income. But at the same time, for landlords, some of these smaller type of landlords they still have to make their mortgage payments to cover their lender obligations, and if they don't cover it, then the lenders have ability to foreclose on the properties. So to answer Simone's question, I guess to address this issue is that there are different jurisdictions, even in Seattle and Bellevue, just 15 minutes drive, the landscape and the laws are very different.
Yeah, I think that's a good summary. And then the laws can change pretty fast, right? Like with the stuff Steve was just talking about, we had eviction moratoria here in Oregon on both the commercial and the residential side, but they were different, right? And they're ending differently. And even when they end, things will be different, right? Like in Portland, it's hard to be a landlord. People complain about being a landlord. You've got a little local registration thing and a tax if you're a residential landlord. And if you want to evict your client, or even if your client's lease is up and you don't want them to stay, you have to pay for them to move, right? That's pretty radical. No other jurisdiction has had that I know of. But New York has things like rent control. Portland has some version of rent control. I don't know how New York's rent control works or if that really matters for investors. Simone could talk more about that. But I guess just getting back to this point of like really understand where and what you're buying, understand the laws, understand what laws may be changing and what's on the horizon and what the general sort of tenor of the environment is before diving in.
I think that's a fantastic point, and Steve, you mentioned it as well, which is kind of the rent issue. The jurisdictional specific issue, like rules related to that, really dramatically change the long-term value of an investment, and is one of the things that are really looked at. Vince, to your point, when banks are evaluating whether or not to make a loan on an investment. I mean, to your point, in New York, it right now takes a year to evict a non-paying tenant, COVID aside. And it is an incredibly tenant-friendly jurisdiction. And they changed the rent stabilization and rent control laws very recently that severely decreased the value of multifamily property in New York City. And the reason for that is that you basically have lost a lot of the opportunity from an investment perspective to increase the revenue generated by your property. And you have the potential for losing months, if not years of rent based on the landlord-tenant laws. And so I actually think it's a really good segue in terms of talking about assembling local advisors. But these are the sorts of things that, again, are issues that you just don't know unless you either are very diligent researching it or have advisors who kind of tell you about what these issues are as part of evaluating the investment opportunity.
I think it's good we pivot and talk about that. I just want to answer a question that came up because I don't know when we're going to get to it out of order. Somebody asked, you mentioned the stepped up basis on death of an owner. Are you concerned that the current political climate might remove that advantage? Yeah. Okay. So yes, short answer is yes. The Biden tax plan, whether it'll get done or what'll get negotiated and hammered out, nobody knows, obviously. But the way it kind of works is currently when you pass away and you leave something to your heirs, in this case, say a house, residential property, they inherit the property. with a basis of whatever the fair market value was on the day that you died and passed it to them, right? I mentioned that earlier. So what Biden's talking about is he's talking about taking away that step up in basis. Basically, your heirs would inherit the property at whatever your basis was. And essentially, people would characterize that as a tax upon death. Is it going to happen? I don't know. It seems like right now they're talking a lot more about infrastructure. I don't know if the tax code will change. I don't know if I would accurately say I'm concerned that the current political climate might remove that advantage, but it's an advantage that people often point to as an unfair advantage for real estate investors under the tax code. And I would take advantage of it while it's here, appreciate it while it's here. Who knows what's going to happen? All right, so that's my 2 cents on that. But let's talk a little bit about assembling local knowledge or local knowledgeable advisors. I think Steve was going to lead on that.
Sure. Yeah. So having local advisors I think it's a very important to have good local advisors, because the urban development process could be very complicated and requires different groups of people who specialize in certain things to be able to provide the investor with good advice. And one key local advisor that I think all investors should have is to have their good, trusted real estate agent or a group of real estate realtors who know the lay of the land intimately. They know the market conditions, and they are out there because they're talking with so many different groups of buyers and sellers. They interact with different architects, attorneys. They are the ones that, if you develop a good relationship with, they are the ones that are prospecting for you. And a lot of these real estate agents, they are working off of a commission structure, meaning that they will try to bring you deals. And if it is actually a deal that closes, then they get a commission, usually from the seller. And so these people, these agents are very important in helping the investor understand the lay of the land, and they in essence help you. They give you the advice on and being able to gain profits on your investment. Another group of knowledgeable local advisors, after identifying a property and while you're doing your due diligence, is getting a group of architects, designers, land use professionals, and engineers. They are the ones that assist you to help you realize your plans. These advisors, professionals, understand what are needed during the permitting process. They help you build and design your building's redevelopment process, and they are the knowledgeable professionals that understand the local jurisdictional issues, right? For instance, Seattle and Bellevue development codes are different. So having these professionals on your side, they will be able to tell you, hey, you hit this in Seattle, you have to watch out for this. But if you're in a different city, you want to be able to look out for a different issue. Another group of professionals that you will be dealing with are the general contractors and subcontractors. They are the ones that do the actual improvements or the value added to the property. And they are very important because they help you understand the costs, the estimated costs of your projects. And since they're the ones that you will be hiring to build out your plans, they will also give you some ideas of the possibility of additional costs that you might not be anticipating. And another group of professionals that all investors should be working with are attorneys. And so, as an attorney, it's a little bit self-serving here, but we seen a lot of different contracts, and we dealt with many different types of clients, seeing them through the entire development process, and we understand the pitfalls, the minefields that clients in the past have An attorney allows you to understand your downside risk, and hopefully a good attorney will be able to advise you on certain ways to minimize those things. And a lot of these local advisors, lastly, I think a lot of these local advisors is that you want to develop these relationships over time. Like Simone said, these you might get lucky, and the first time you work with your joint venture partners or your local advisors, you find out, hey, they are great, they're very good at what they do. But a lot of times you'll find out these advisors, it will require some time to develop as you get to know them and as they understand your investment purposes.
That's great. I think it might be a good time to talk a little bit more about navigating urban construction issues. Simone, are you interested in leading on that?
Yeah, I think that's kind of, Steve, what you just finished on is a perfect starting point for that. Because, the way that every contract starts, every development process starts is always with the best intentions, and everyone is always very excited at the closing because they now have a brand new shiny asset where they're just looking at the returns on their investment at the end. And what lots of people don't think about is what happens between the closing and when you actually are generating revenue from this asset that you've purchased. And in the development context, that requires going through the construction process. And the reality is that for almost everyone, it's an opaque process. It's one that you don't really know until you get involved with it on a project basis and you go through it the first time and then, more times after that. And, a great example of this is, from personal experience, I've negotiated hundreds of construction contracts with contractors. And I talked to both of you about it, but we're, renovating our house for the first time. And this is the first time that I've actually been on a construction project on a day-to-day basis. And you begin to realize that there are certain parts of every project that are a little bit different. And without having full understanding of what the cost is on a daily basis and all of that, it makes it it makes the process just a little bit harder. And so the way that we help our clients navigate construction issues throughout the process is step one is always, always, always vetting the contractor that you're getting involved with. And there are lots of different ways of doing it. There's the direct way of doing it, which is getting as many referrals and finding out what the contractor's experience is and seeing whether or not there are violations issued against them in the local administration, or whether or not your broker has had experience dealing with this contractor and having all sorts of issues. Another important part of that, and this is I'm still talking about vetting the contractor, is through your architect. And if you find an architect that you're comfortable with and that you decide to work with, in a lot of ways, the architect becomes the owner's eyes and ears on a project. And oftentimes, an architect's agreement has an owner's rep component to it. And what an owner's rep is literally that, the owner's representative on the project. And they're the ones who are really not only responsible for preparing the plans pursuant to which work is going to get done, but actually going to the site on a regular basis and making sure that the work that's going on as part of your development is actually what it's supposed to be. That foundation is being poured correctly, that if you're doing some sort of waterproofing work, that the waterproofing materials are being done properly, and that basically things are going in the correct order and being done the correct way. And, once you've identified a contractor that you've decided that you're going to go forward with, the actual construction contract is oftentimes the most important document with respect to the development process, because it is critical to one, both preserving your rights as an owner in terms of issues that may arise during the process, which often do happen, but also when drafted correctly, creates a very powerful and important disincentive to the contractor for bad actions, for taking too long in the process, for not doing work properly. And there are lots of different ways that that should be accounted for. The biggest areas that we see that I think are almost most important when kind of preparing for construction issues are delays, because again, as we talked about before, where there are delays in the project, it has a real day-to-day value in terms of carrying costs on an investment, and contracting properly for what happens if there are delays and who are responsible for those associated costs are really important. How disputes get resolved with the contractor in the event of, again, delays or defective construction, when there are issues that come up. And then the last one, which happens with unfortunate regularity, but is a real part of the construction process across the United States, are injuries, workplace injuries that take place on a development site. And the reason why that's so important is that without having the proper insurance, without having the proper defense and indemnification language in a construction contract, as the property owner, in many jurisdictions, you're at risk to be liable for someone who gets hurt either walking by the project or working on the project, to the tune of potentially millions of dollars in worst case scenarios, which very easily could be the difference between having a successful project and having a project that's lost money. And so it's really important to make sure that when you are at the onset of construction, that you have a contract that really protects your rights, but also that accounts for all of the issues that may come up. And, I cannot stress, and I know that this may sound a little bit self-serving, but I cannot stress the importance of having an attorney who understands the construction process, because if small things are overlooked, it creates the potential for being literally years-long litigation over issues that arise. A few other major things that come up as part of construction issues on the project: mechanics liens and payments, which is in the event that there are issues over work that's been done and whether or not the contractor needs to get paid. In many jurisdictions, the contractor has the right to file a lien against the property, which can make it very difficult, if not impossible, to sell, to refinance, potentially has the impact of foreclosing your ownership in very rare circumstances. But it's really important to understand those issues and to protect against them as you're going through the process, because if you don't, it again could really have an impact on whether or not the project is financially successful or not. The last thing that I from an urban construction issue perspective, although I think this really does apply across the board, is issues that you discover after the project has been completed. And that really very often happens because lots of underlying construction issues kind of don't get revealed until a year, 2 years, 3 years after the fact. Because, for example, water infiltration is not something that happens the first time it rains, but the 100th time it rains. If your building hasn't been constructed properly and there isn't a proper water envelope to the building, all of a sudden, if you're a rental building owner, you have leaks in your building and you have tenants who are refusing to pay because every time it rains in Seattle, water is dripping down the sides of your tenants' walls. And, understanding kind of both making sure that the work is getting done properly during the course of the project, but also having the right protections in place for issues that are discovered after the project. And every state has its own statute of limitations and various warranties that are automatically in place with respect to new construction. These are all things that are really important to be both aware of and to plan for as part of actually undertaking an investment in urban real estate in the U.S.
That's great. I think just because we had a little bit of a late start, we could go just a few more minutes, and I'd like to take the opportunity to talk about contracts and answer a particular contract question. It looks like somebody wrote, do you all like AIA contracts in general? Are there particular clauses that repeatedly cause trouble in this arena? How do you resolve generally? I have a few thoughts about AIA contracts and contracts in general, but I want to kind of defer and see if Steve or Simone have particular thoughts before.
I, as simply as possible, I think that AIA contracts are a great starting point. Beyond that, they all require real customization to really make sure that you're protected and that you understand what the issues are. And that's kind of the beauty of the AIA, that they've created a very good baseline that is customizable in a way that that can work. But I think that it is, I like them. My standard form is generally not an AIA, although, I've had clients who prefer working with them. To the second part of the question that I think I saw, which is clauses that repeatedly cause trouble. This, in many ways, the single most important provision in any contract with the contractor is dispute resolution. And there's a lot of different ways that provision can be structured. Oftentimes, there is an initial decision maker where the architect or another third party is designated as the person who's supposed to resolve those issues. And it's a very cost-effective way of dealing with issues without resorting to litigation or arbitration, which immediately becomes very expensive for all parties. And how much pushback you get on how that provision is drafted when dealing with the contractor really kind of gives you a pretty good indication of what you're going to be dealing with over the course of the project.
Thanks, Simone. Steve, any thoughts on AIA contracts or contracts in particular?
Yeah, I think it's very important for the client to understand the documents, whether it's AIA or anything that's customized. And also to add to that is just understand your needs, and you want to communicate that to your advisors, because even though there is a baseline and where you're negotiating, if you don't understand what your needs are or your desired outcome, a lot of these contracts could come back to haunt you in the future. So all I can say is AIAs are great, but understand what's in them.
Yeah, I think I agree. I mean, to the extent we have an industry standard, AIA is the standard. You see them a lot. I like that they're customizable. I like them more if I'm representing, say, an architect than a subcontractor for various reasons. They limit subcontractors' access to information in a lot of cases. They give the architects a lot of power. They're good agreements, but I mean, you can't just use an agreement, off-the-shelf agreement in general. That's a general thing throughout the law, and I think that's true with construction or property acquisition contracts, whichever it is. I think you've got to look closely, understand what you're getting into, understand that a lot of things are highly negotiable. Markets are different. Something that may be market in one place is not market in another place, whether that's period you can do diligence, whether that's which contingencies you can ram into a contract, whatever. I think you just have to work with people who can navigate those contracts, but I think they're good forms to start with. That's how I would think about them. Okay, guys, we're at almost 12:05. I think we started a few minutes late, but we want to be respectful of everybody's time and log off. We'll replay the webinar at some point on one of our law firm blogs. There's a Harris blog you could find. Thank you very much for joining us. Thanks for all your questions. We appreciate everybody's input, and we'll see y'all soon.